It's a sign of good evening, I think, when attendance straggles in. And as I understand it, diplomatic relations and socializing are one of the priorities of the conference. So it's a good sign. So after spending a lot of yesterday talking about supply, I actually wanted to spend a bit of time this morning talking about demand, because a lot of the discussion over inflation in the past 2.5 years has focused on supply. We've heard about supply chains, port capacity, pandemic-related supply disruptions, Russian invasion of Ukraine and the effects that's had on global grain and energy supply. But I actually think most of the inflation story of the past couple of years, at least in the United States, has been a story about demand. And we can see preliminary evidence of the importance of excess demand in generating inflation by looking at the timing of the initial divergence in inflation in the United States versus in the Euro area, which is another big, fairly similar economic area that, like the United States, like UAE, experienced global shocks in 2020, 21, shocks like supply chain disruptions, pandemic-related disruptions, etc., but didn't have that initial surge, or didn't have an initial surge in inflation of quite that magnitude. So this is a harmonized index of consumer prices in the Euro area and the United States. Say harmonized because when you're looking at inflation across countries, you want to be able to compare apples to apples because different countries measure inflation differently. But as you can see, if we look at a harmonized index of consumer price inflation in the US and the Euro area from 1998 through February 2021, so just on the eve of March 2021, and I'll get into what happened in March 2021. You see that consumer price inflation was pretty roughly equal in both these economies. Then you get to March 2021, and what happens? You have inflation jumping in both economies, but the magnitude of the increase in inflation in the United States is about 4 times that in the Euro area. Then we get to the Russian invasion of Ukraine, February 2022. By this point, inflation in the United States begins to come down, particularly as the Federal Reserve started hiking rates right about this time, while it spiked in the Euro area. The Euro area was much more impacted by the rise in energy inflation after the Russian invasion of Ukraine. So, in fact, in those 12 months through February 2021, inflation in both economies is almost identical. It was 1.1% in the Euro area, 1% in the US. So what happened in March 2021 in the US that didn't happen in the Euro area? Well, in March 2021 in the US, we had the largest fiscal stimulus during a peacetime economic recovery in US history. It was $1.9 trillion. That's equal to 10% of the annual output of the entire US economy. So March 2021, we have a fiscal stimulus bill, deficit finance, equal to 10% of the annual output in the entire US economy. Now that followed already in 2020, we had $2.2 trillion pandemic emergency package in the CARES Act. So that was during the depths of the pandemic recession. And then that was followed by a $900 billion emergency supplemental bill in December 2020. And then on top of that, in March 2021, the U.S. poured an additional almost $2 trillion in stimulus that consisted almost entirely of direct transfer payments to households. Households which, by the way, were already sitting on about $1.7 trillion in what we might call excess savings. So this is personal income for all households. And you can see that I fitted a trend to that personal income. You can see how smooth it is. Then we get to the pandemic and jumps massively above trend as we have subsequent rounds of transfer payments to households. And at the same time, this is personal consumption expenditure. This is what households are spending during the pandemic, during the shutdowns. A lot of households just weren't spending as much as they otherwise would have. So you get this big increase in household savings relative to what they otherwise would have been saving. And by March 2021, that was equal to, as I said, $1.7 trillion. So what happens when you pour an additional $1.9 trillion in spending on households or onto an economy that already has about $1.7 trillion in excess consumer savings? I'm sorry? Well, savings did rise even more. Yes, savings did rise even more, but spending also rose. Because by this point, March 2021, we're 11 months into a recovery. We have multiple vaccines. People are starting to go out. So this is consumer spending on goods in the United States. And consumer spending on goods had actually already returned to trend by early summer 2020. By the end of 2020, consumer spending on goods was actually slightly above pre-pandemic trend. We get to March 2021 and consumer spending on goods jumps 11% in 1 month, month over month. That's a 240% annualized rate of growth in consumer spending. Actually, here you can see it in real terms, so inflation adjusted. You can see a big quantity jump in the volume of goods demanded by U.S. consumers. So consumer spending on goods went from 8% above trend already to 19% above trend in March 2021. Now, some of that increase, as I said, went into prices. Some of it went into quantity. That's a big increase in demand. That's a lot of demand. 240% annualized rate of growth in 1 month. So we heard a lot. I don't know, you might have heard some of this over here. We heard a lot in 2021 about supply chain disruptions, clogged ports. I gotta say, I think our ports and supply chains did a remarkable job in 2021. They handled a volume of imports that was 20% above import volumes in 2019. That's pretty impressive. So we get this big excess of demand over supply, and it's especially in the context of a supply side of an economy that's still recovering. So in early 2021, so we still have, I'll get to that later, I guess. So we have this big increase in demand. Probably, you look at what were pre-pandemic estimates of the potential output of the U.S. economy, how much could the supply side of the U.S. economy produce? And then you look at how the increase in aggregate demand relative to that potential output, and it was about a 5% gap. 5% gap between what consumers were demanding and what was the potential output of the U.S. economy. But even that 5% gap is probably generous, because this was not the pre-pandemic economy in early 2021. This was an economy that during the pandemic had experienced 1.5 million early retirements. So these were people who during the pandemic, 55 and older, they said, I'm leaving, I'm taking early retirement. This was an economy that had 3.7 million Americans still reporting that they had not looked for work in the past month for pandemic-related reasons. This is an economy that had a cumulative shortfall since the start of the pandemic of about $500 billion in business investment. And this was an economy with transitions from unemployment to employment that were historically quite low. And they were low in part because of the pandemic itself, but also because, as I briefly mentioned yesterday, there were during the pandemic and in especially in the March 2021 bill, there were dramatic increases in transfer payments to households that phased out as people earned income. And there was also a dramatic expansion in a child tax credit that essentially eliminated work requirements. So that's why we were in early 2021, people were not transitioning from unemployment to employment at typical rates. And we can actually see this by looking at what's called the beverage curve. So the beverage curve is sometimes called the neglected stepsister of macroeconomics. It is much less well known than its more famous or infamous relative, the Phillips curve. What does this curve tell us? So right here we have the unemployment rate, and right here we have the rate of job openings. How many job openings are there relative to total employment? Now, in a perfectly efficient labor market, you can't have unemployment and job openings existing at the same time. Why? Because if you have a job opening and an unemployed worker in a perfectly efficient labor market, that job opening is going to be immediately filled. So you can tell something about the efficiency of a labor market at matching unemployed workers to open jobs by looking at how far out your beverage curve is. So this is the beverage curve in the early 1950s. And you can see it was pretty stable, consistent with fairly efficient labor market matching workers to jobs. By the early 60s, though, we start to see a decline in the efficiency of the U.S. labor market. It's just not doing as good of a job matching workers and jobs. Continues to shift out in the 70s. And there are lots of reasons for this. One was just structural change in the U.S. economy. So throughout the 60s and 70s, we had some regions of the country that were declining. So this sort of post-industrial decline in the Midwest in particular, while other parts of the country were growing very rapidly. And it's not easy to move workers from where unemployment is relatively high and labor demand relatively low to where unemployment is relatively low and labor demand relatively high. But it was also that we had an increase in the strength of collective bargaining. So that there was, there were more employment protection laws that can make labor market mobility a little bit more sticky. There were differential changes in transfer payments, and there was a rise in home ownership, which is a good thing, but it also means less labor market mobility. For a bunch of reasons, labor market mobility declined in the 60s and 70s, reaching a peak in the late 70s into the early 80s, after which we started to shift back in, consistent with more efficient labor market matching into the 2000s. This is where we were on the eve of the pandemic. I mean, just about your typical post-war beverage curve. That was where the beverage curve was during the pandemic and into 2021. That was the least efficient labor market in U.S. history. And yet that picture right there, that is not the picture of a healthy labor market. That is not the picture of a labor market that's doing a good job matching unemployed workers to open jobs. And yet that is the labor market, that is the economy onto which we poured $1.9 trillion in additional stimulus. And then since there's been some return of efficiency, and we're pretty much now just at a point, at a level that's consistent with a lot of labor market tightness. So here we have this unprecedented stimulus to demand, an exacerbation of existing supply side problems. And that difference, as I said, between supply and demand, it's got to go somewhere. And in 2021, it went into prices. We had a lot of explanations in 2021. Some of you might have heard the term team transitory. So a lot of economists, a lot of respected academic economists suggested that the inflation that we were seeing in 2021 was temporary or transitory, resulting from special one-off factors. So we heard people say, used cars are surging in prices because there's a global chips shortage. We heard about semiconductors specifically, chips specifically being a cause for the inflation that we were observing. A lot of one-off factors. And that reminded me of actually the late 1960s and the 1970s, which was the last time that inflation and inflation expectations became unanchored in the US and indeed globally. Writing about the great inflation of the 1960s and 1970s a few years ago, the late economic historian Alan Meltzer, a monetarist and student of Milton Friedman, wrote this. So this is Alan Meltzer writing in 2009, I think, 2010, about the origins of the Great Inflation. Not a student of Milton Friedman's, but a monetarist in his footsteps, you could say. This is Meltzer. Policymakers denied for several years that inflation had either begun or increased. They did not deny the numbers they saw. Rather, like Gardner Ackley. So Gardner Ackley was a predecessor of mine at the Council of Economic Advisors. He was a member of the council under President Kennedy and then chair of the council under President Johnson. Gardner Ackley wrote, like Gardner Ackley, they gave special explanations, a relative price theory of the general price level, in effect claiming that the rise in the price level resulted from one-time transitory factors, transitory changes that they did not expect to repeat. Later, they added other explanations, especially that the cause of inflation had changed from the classic demand pull to the new cost push. Sound familiar? Now, the interesting thing about the inflation shock that arrived, that hit the US and then subsequently global economies in 2021 and 2022 is just the magnitude of the shock and the persistence of that shock. Because when inflation is low and stable, consumers don't really pay much attention to inflation. They look through initial shocks. But this was a big shock in early 2021. How big? Well, before 2021, there were 4 instances of inflationary shocks that were equal to 3 standard deviations or more relative to a rolling 5-year average of inflation. So you have inflation bumping along, and then sometimes you get a shock that's just equal to 3 standard deviations of what you've been used to. So that happened in the first quarter of 1966. It happened in the second quarter of 1973 during war in the Middle East. It happened in the fourth quarter of 1973. It happened in the first quarter of 1974. And then it happened in the second quarter of 2021. Now, the reason this matters is because when you perturb inflation like that, suddenly consumers, businesses start to take notice. So I actually have a research paper at the moment looking at over the long run, who does a better job predicting inflation. Do consumers, ordinary consumers, do a better job, or do professional forecasters, professional economists? And it turns out the answer is it depends. So when inflation is low and stable, the pros actually do a pretty good job. They're passing most tests of most conventional tests of forecast rationality. Their forecasts are unbiased. And consumers are failing every test of forecast rationality. They're just not paying attention. But when inflation gets above a certain point, or when inflation is especially volatile, then suddenly the pros are bombing. They're not doing a good job predicting inflation because they keep expecting inflation to go back to normal, because they keep thinking, hey, you have this energy price shock that will dissipate. You have this food price shock that will go away. But the consumers start paying attention, and they're basically acing every test of forecast rationality. Now, does that mean that we're going to relive the 1960s or the 1970s in terms of inflation? No, I don't think that's written in the stars. And indeed, you can look already. We've seen inflation come down substantially as the Federal Reserve has hiked interest rates. And by some measures of inflation, we're already back almost to the Federal Reserve's target. Rather, my point is that once you have perturbed inflation expectations and consumers have started paying attention to inflation and businesses have started paying attention to inflation, then a lesson of history is that history happens. You get a geopolitical shock. You get a pandemic disruption. You get a new round of fiscal stimulus. And when consumers and small businesses are paying attention to inflation, then you can get a jump back up. That's what it means for inflation expectations to be unanchored. And I want to leave plenty of time for questions, both to follow up on yesterday's discussion and today's. But I want to leave you with this thought. In late 2019, there were some concerns among some economists that inflation was going to soon become a problem. We had had unemployment below 4% for 24 months. It looked like the U.S. economy was bumping up against its potential output, or even above its potential output. And inflation was approaching its 2% target. At the time, I gave a talk at the Bureau of Labor Statistics in the United States. And I said, so this is November 2019, I said, no, I don't think inflation is going to be a problem for this economy because I see a lot of differences between 2019 and the 1960s. What were some of those differences back then? Well, in the late 1960s, when inflation first started to get out of control, U.S. labor market was very, very tight. Labor force participation in the United States had pretty much maxed out because we were at war. We had several years of fiscal stimulus. And so prime age male labor force participation in the late 1960s was 97, 98%. And female labor participation was starting to increase, but that was sort of a slower, longer run process. So we have a labor market in the late 60s that's pretty maxed out. We also had fiscal policy that was very stimulative. So in 1965, President Johnson launched his Great Society program. So there were a lot of subsidies to the healthcare sector, a lot of increases in transfer payments to households. And the challenge was that the supply side of the U.S. economy just couldn't immediately respond to that demand. So we saw in the late 60s, we saw double-digit inflation in a lot of healthcare because there were massive new subsidies for healthcare, but the capacity just wasn't there to supply it. So there was that fiscal policy in the 1960s. There also in the 1960s was coordination coordination between fiscal policy and monetary policy. So in the federal government, there's something called the Troika. It's the Council of Economic Advisors, the Department of the Treasury, and the Office of Management and Budget. And the job of the Troika is to come up with the administration's forecast, to determine the budget, and basically to map out an administration's economic policy agenda. Under President Kennedy and continued under President Johnson, there was what was called the quadriad. So it was the Council of Economic Advisors, the Department of the Treasury, the Office of Management and Budget, or then it was the Office of Budget, and the Federal Reserve. And they would meet. And in the annual economic report of the president, the Council of Economic Advisors would actually say, this is what we think monetary policy should be in the coming year. And they would say, for example, after President Kennedy's tax cuts, they said, we do not think that the Federal Reserve should choke off the salutary effects of our tax reform, and therefore they should accommodate. And a fourth key aspect about the 1960s was monetary policy hubris, confidence. You had in the 60s a sense among many academic economists and many economists at the Federal Reserve that they'd figured it out. They knew how macroeconomics worked. They knew that there was a stable relationship between unemployment and inflation that they could exploit. We want to get unemployment a little bit lower. Well, we can tolerate a bit higher inflation. And there were eminent economists who had, in the early 60s, supported this and given intellectual credence to it. It turned out to be wrong, but there was a lot of confidence then. So in November 2019, I laid out those key characteristics of 1960s economic policy. And I said, I think it's different in 2019. In 2019, we had rising labor force participation. I noted yesterday that we had 2.3 million prime age Americans enter or re-enter the labor force in 2017, 2018, 2019. 3/4 of the flows into employment were people coming in from out of the labor force. In response to marginal income tax rate reductions, we saw older age cohorts participating at higher rates. So I thought that's different. I also thought that the composition of fiscal policy in 2019 was very different from the 1960s. So we just had big business tax reform that was inducing a lot of investment in new capacity. We'd had marginal personal income tax rate reductions that was incentivizing increased labor force participation. I thought all of that was increasing, on net was increasing the supply side potential of the U.S. economy relative to demand. In terms of fiscal and monetary policy coordination, we had a president who would tweet about the Fed, would say what he thought the Fed would do on Twitter, but there was no fiscal or monetary policy coordination. There was no quadriad. There was no Council of Economic Advisors writing in the economic report of the president, this is what monetary policy should do. And finally, I thought the Fed has learned its lesson. The Fed learned its lessons, learned the lessons of the 1960s and the 1970s. And generally speaking, over the long run, over the Fed's long history, they make a lot of big mistakes, but they also have a capacity to learn from those mistakes. Fast forward to 2021, to the present. I don't think a lot of those differences I noticed in 2019 still hold. So if we look at the past 6 months, labor force participation in the U.S. looks like it's pretty tight and was flat for many months, which suggests that when you have a demographic trend and you now have prime age labor force participation that has reached its pre-pandemic level, that's a tight labor market. And I hope that there's a lot more room, but it's, as I said, it's looking pretty tight. And you can see it in the beverage curve. That's a very tight labor market. Also, the composition of fiscal policy. 2019, there was fiscal policy that was lowering marginal rates, that was incentivizing business investment and new capacity. Since then, you could debate the composition of fiscal policy. I mean, there was a $1.2 trillion infrastructure bill. Maybe that'll increase the supply side potential of the U.S. economy, but it's hard when you're pouring deficit finance money onto a 3.5% unemployment rate economy, when you're pouring $1.2 trillion deficit finance spending onto economy in which households are borrowing at over 7% to buy a house. That's a supply constrained economy. So I think a lot of that spending is going to go into prices. And then on top of that, we had $280 billion in deficit finance spending on particular sectors. This is industrial policy. We had a $1.2 trillion bill to invest in or subsidize other favored sectors. Again, industrial policy. Maybe it increases the supply side potential of the U.S. economy. I think it's also just going to increase a lot of demand and put a lot of pressure on prices. There's also increasingly in the U.S. and in other economies, at other central banks, one gets the sense that some people think that the goal of monetary policy should not just be price stability, should not just be maximizing sustainable employment, but should also pursue other goals. Equity, combating climate change, and those other goals may be consistent with price stability, but they may not be. And then there's also a bit of a return to monetary policy hubris. Certainly in 2021, even into 2022, a lot of central bankers took comfort in the observation that surveys of long-run inflation expectations showed that consumers' inflation expectations over the long term, at least, still were pretty low, consistent with stable price inflation. And therefore, maybe there's not so much of a trade-off to have to worry about in terms of economic slack and inflation. So whereas in 2019, I was seeing a lot of differences between the economy of 2019 and the economy and economic situation of the late 1960s, 2021 to present, I worry that there may be a lot more similarities. Again, not predicting a return to anything like the inflation of the 60s and the late, and in particular the 70s, but rather the conditions are similar. And as I said earlier, once you perturb, once you disrupt those inflation expectations, history can happen and you can get a shift upward. So I'll return and conclude with the point I opened with yesterday. It's very tempting for policymakers to focus on moving demand, but they neglect supply very much at their peril. So I'll pause at that and I'm open to questions.
Tyler, and I'm not sure, the challenge will have chair. How much of his decision to wait till housing vacancies help him on 2021 is a function of maybe he done it earlier, why would you wait? How much of it was interest? When date law, waited too long and got waited a bit.
So I'm actually working on another project at the moment, in which I'm coding every member of the Federal Open Market Committee going back to 1936 and their background, including, were they a PhD economist, were they a lawyer, were they a banker, who appointed them, which party appointed them, and how did they vote in a year in which a chair or vice chair was going to be vacant, or a year in which there was an election. And unfortunately, I haven't finished the project, so I don't have the answers to that. And I can't get inside Jay Powell's head. I think he's done I can't get inside his head. It's certainly conceivable that it was a factor. But I would say more generally, I do think that the Fed were prisoners to their new framework, and they were prisoners to recent history, in which they had been struggling to get inflation back to 2%. And that definitely impacted how they thought about what they were seeing. And it didn't help that they had much of the academy saying, oh, this is transitory, this is temporary, just like in the 60s. And the third thing, which is if I want to cut them some slack, I would echo what several of the members told me, which was that, well, there were a lot of big upward revisions to the jobs numbers in the first half of 2021. So the initial job numbers came in pretty disappointing for, an economy that's got vaccines, that's still reopening. And then subsequently they were revised up massively. And so at the time they were kind of uncertain. They thought, we don't want to fall into a secular stagnation again, which I personally thought was ridiculous, because this was not this was a lot of demand intersecting with limited supply. So this is not the 2010s. But that's if one is going to cut them some slack. But I think it was probably a combination of tactical thinking, a wrong framework, and just bad interpretation of incoming data.
Well, that's in this data about the defense audience of institutions. Yeah, there was more with the one senators in the mid to the other regular. They want you to all sending more money.
So people bought a lot of stuff because, especially in 2020 and even into the first half of 2021, a lot of the country was locked down. A lot of facilities were restaurants, theaters, the types of places where people go to consume services were closed or partially closed. And so you have people in their houses with a lot of money that was sent to them by the government. What are you going to spend it on? You're going to spend it on new television set. You're going to spend it on new home furniture, on new yard equipment. And that's what happens. I think that rather like with monetary policy, fiscal policy was very much waging the last war. So after 2008, 2009, many in academic economics thought that they should have gone bigger, that they should have done a bigger fiscal stimulus in 2008, 2009. And they didn't want to make that mistake again, so they went really big in 2021. But I think that was very much misdiagnosing the nature of the challenge in 2021. And it was a false positive. It was sending way too much money to households and businesses that in retrospect would have been fine with substantially less.
If the border basically can find your thoughts on that expensive and it's in the night. That's at the concept. I right now, for example, if the wall have some politician that want to be in the way, and that sense actually then the single grow. Sometimes you have a human banking very proactive. They are being birth time that you might not want to make this not the thing that you will end up to something the policy water ball.
Central bank independence is essential. And I think central bank independence, especially when there are early empirical studies that showed a very strong correlation between central bank independence and income per capita and growth. And you look at countries that went from lacking central bank independence to having central bank independence, and there's a market improvement. And I would actually even say that for most of the past 40 years since Paul Volcker, the U.S. central bank and other major central banks have done a pretty good job at achieving their mandates And this was it was the past 2.5 years that were a big screw up. But I think the role for government, for elected policymakers, is to set the mandate for the central bank, set a clear mandate for the central bank, and then provide them with the independence with which to execute on that mandate.
So does it matter?
It does. It does. And some central banks have a mandate to deliver price stability. Other central banks, like the Federal Reserve, have a mandate to deliver both price stability and maximum sustainable employment. And that's up for elected policymakers and elected officials to set those mandates. Yeah.
Not a big thing, but why you let?
So I think in retrospect, the packages that Congress passed in March 2020 and then at the end of 2020 were too big. That was in the context of in the second quarter of 2020. So just the CARES Act was passed in late March 2020. The next quarter, the U.S. economy declined at an annualized rate of over 30%, which would have been the biggest decline in economic output since 1932, one of the worst years of the Great Depression. And then at the end of 2020, there was a pretty serious third wave of the virus that sparked a lot of concerns that the U.S. economy could be heading south in a big way again. Was it too big? It was too big. But there's also a difference in the context of, March 2020 was a pre-vaccine world. December 2020 was the first vaccines had just been discovered. People weren't sure how quickly they would be able to, that those would be rolled out. That's a different environment. That's a different set of information from March 2021, when you're then 11 months into an expansion, the vaccines are rolling out. So I think legislators and policymakers can be cut some slack for decisions made in the fog of war, less slack when they have a superior set of information and a very, very different macroeconomic context.
I thought it's fascinating when they up to consideration. COVID, found states' ability to rate. Question is, let's vote. Is that states investment so that match stimulus to votes that doesn't funnel it out?
Yes. As I noted yesterday, in terms of income replacement, the efficient thing to do is to target income replacement to where income needs to be replaced, namely who has lost a job. And so Congress really wanted to supplement the typical unemployment insurance compensation, given the unique circumstances of 2020. And ideally, you would do that by instructing states to, instead of compensating unemployed workers with 50% of their former income, maybe 75%, 80%, even 100%. But we had about, I think it was 7 or so states whose IT systems were so antiquated. They were running on, most of you are probably too young to know this language, but COBOL. And they could not plug into their system a percentage compensation or percentage replacement rate for unemployment. So instead, Congress had to just stipulate, do the standard 50% plus an additional several $100s per week. So I think it would be very worthwhile to invest in upgrading those systems so that future Congress would have the flexibility to make that sort of percentage change stipulation. in terms of the economic impact payments, so these were the checks sent to households, and this gets to your point about sort of false positives, and your point about things being untargeted. And it was the stimulus checks were targeted in the sense that there were income thresholds and income caps, but part of the motivation at the time for sending out those checks was that these old IT systems were creaking, and actually several of them collapsed in the first couple of weeks of shutdown. So there were in some corners, there were concerns that 22 million people are losing their jobs. Consumption is 70% of the U.S. economy. We're not sure if the unemployment insurance system is going to be able to bear this. Therefore, we just need to get money out. So if upgrading the systems can help one avoid those sorts of massive false positives, then I think that's probably a worthwhile investment.
Oh, it's off topic. Right, it's another one. So I was recently in California. It's really Yes.
I was recently in California. Oh, thank you. I was recently in California. One of the problems that people coming from Europe or from other countries noticed that there are many more homeless in the street in San Francisco and it's common in other cities. So I was just I was speaking. I was there also with some girl from Denmark, which was also very obvious to her. She was like commenting all the time. So just wondering, what do you think should be done in that sense? Is there anything that can be done? Is that a problem? But just from a California point of view.
Yeah. So, right. So I should specify that it's not my area of expertise, but it is interesting to look at the levels of homeless population in different parts of the country, and you do see higher homelessness in areas where it is less harsh to live without shelter. But the levels of homelessness in major cities in California is just astronomically above anything that climatic conditions would predict. And there are a number of reasons for that. One is California, and in particular, certain cities in California, the Bay Area is one, have some of the most restrictive levels of regulation on the ability to build new houses. So there's a cost of housing issue. There's also a challenge that a lot of that there are sort of network effects, because a lot of these people they need help. They need help. They have their mental health issues. There are drug addiction issues, and you could have network effects, because if you have a challenge with addiction, then you gravitate to where you can meet other people and acquire substances that your body seems to need. So I think that helping people overcome some of these issues rather than facilitating or letting this go on is what a compassionate policymaker would do. And unfortunately, I don't see compassion in the major cities, California, or compassion in the California government, because they are letting people suffer.
So, let me say, the kids are not to the jail. Since what we're talking about here in Cobra, that they're okay. Buy it. This question, what? Now, how does it? You know, on the pot.
They're not consistent. 1 to 92 to 1. You look at my thing, this study so don't think. Should it not. There you but for 1 to 92 the album on stage. Younger than 50, then you towards music. I was fine. I'm going to that war mommy governing what it's map it back which that number the film your discussion about inflation. I assume that the EDR would have been more opportunity wherever go. I would say it this way. We asked Speed in our program, but here at Atlas, indicted. In fact, he fixed secure law 2 years. Said we should stay while we get here. We went inflation stock in 6 the end of the year. We should move up. So they should not look totally at. And I wanted to speak in our program. Our love on the is around. That's what I said on the air. Lastly, the prick. Military planning. Side and more. Have to extension. Not to address any wood. And it said for class of Israelis, by the way, you're going to have it too. And turned out he was also a senator. So, what things, what inflation everywhere, at every place, a monetary phenomenon. Those are my 2 questions. What is your take on that? Number 2, what are the usual acid shank forces at states?
Right. So certainly at an intuitive level, one can easily observe that there isn't a lot of productivity. There are not a lot of productivity gains coming out of government, but it's actually even more straightforward than that. Definitionally, productivity gains are in the non-farm business sector. There is no productivity gain whatsoever in government. And in fact, government's contribution to GDP is simply hours worked times wage. So there's no measure of quantitative output. And it is a problem that, and you see this in France, where government accounts for over 50% of the economy, and it's tougher to eke out productivity gains when a non-productivity generating sector is consuming 30, 40, 50% of the economy. And it's likely to get worse for this reason. You look over the past however many decades, and you look at the price index for goods, and it will have gone down by a factor of, I don't know, 30. I could even be off by, large magnitude, but it has gone down substantially because there have been quality improvements. Products have gotten a lot better. Your iPhone is better today than it was 10 years ago, and you didn't even, and your iPhone is substantially better than a walkie-talkie 40 years ago. You look at a price index for services, and it's probably gone up by a factor of, 100. It's gone up massively. Now, what does government spend money on? Government mostly spends money on services. It subsidizes educational services. It spends a lot on healthcare services. So government's spending a lot on services and spending even more on services as populations age. But government's tax base, their revenue base, is goods and services. So I think it is very concerning that a non-productivity generating sector is not only consuming a lot of the U.S. economy, but is likely to consume even more as this transition to a more services-oriented economy continues. On the monetary question, I do agree with Steve Hanke, and I focused on the massive fiscal stimulus to demand. Had that stimulus not been accommodated by a Federal Reserve, I do not think we would have observed the inflation problem that we did in 2021, 2022. So I think it was an error of accommodation on the part of the Federal Reserve that allowed this inflation problem to get out of hand. And I would note a contrast between 2021, the Federal Reserve's behavior in 2020, 2021, and their behavior after 2008, 2009. If you look, as I'm sure Steve Hanke has, if you look at a graph of broad money supply in the United States, it was actually pretty smooth in the aftermath of 2008, 2009. And there were multiple reasons for that. One, we had financial regulation that was forcing banks to hold a lot more capital. We had households and financial businesses that were repairing their balance sheets. And we also had a Federal Reserve that started to pay interest on excess reserves. So basically, with one hand, they were buying a lot of treasuries. With the other hand, they were then paying banks to park that cash at the Federal Reserve itself. So it was very smooth growth in the money supply after 2008, 2009. And then you look at 2020, 2021, and it's just a remarkably sharp increase in broad money supply as the Federal Reserve accommodated several $1 trillion in deficit finance fiscal stimulus. And I think Steve has actually predicted then the sharp decline in inflation that we've seen, because once the Federal Reserve did belatedly start to tighten monetary policy, we did actually start to see a decline in N2 money supply. And that was also partly because consumers, households had built up a lot of deposits at banks, and they started spending down those excess savings. Those deposits started to flow out, and we had a decline in N2 money supply. And I think that's why that's in part why we've seen the decline in inflation that we've seen over the past year and a half.
So let me go back to Mishima. Have the nurse or put it thinking of it. Really, the story was it fine? Or we're popped it up. And that's so bad. One odd hour. It's polish with but shouldn't that be in a job? If you integrity direct say that's again or what you see what you see but it then it's own spots like how they stop.
So I think the dual mandate has served the U.S. quite well over the past 40 years, has generally served the U.S. economy quite well over the past 40 years. So the dual mandate is price stability and maximum sustainable employment. And I think that mandate served us very well through 2021. And then the Federal Reserve made some mistakes, but they are correcting those mistakes. Other countries have a single mandate. So I think the European Central Bank's mandate is just price stability. But I think the dual mandate has served the U.S. well. And I do worry that many central banks are granting themselves additional mandates that may not be consistent with price stability.